Welcome to the Deep Dive, where we do the hard work of digging through the data so you don't have to.
Today, we are definitely strapping in. We're looking at the fiscal Q3 2025 earnings call for Clear Secure Inc. That's ticker UU on the NYSE.
And this call, it really wasn't just about getting through airport lines faster. The whole strategic frame has shifted.
It really has. I mean, the CEO kicked things off by saying it is an incredibly important time to be a secure identity company. That sets a totally different tone.
It does. It positions them way beyond just travel. The message is that identity is the foundation of trust. And they're tying it directly to, well, the biggest digital threats we face.
Exactly. They're connecting the physical and the digital. The CEO made this great point that criminals today, they aren't breaking in, they're logging in.
Right. Something like 80% of data breaches start with stolen credentials.
And that's their whole argument. By securing your physical biometric identity, they become a critical piece of the enterprise cybersecurity puzzle. It completely elevates the investment thesis.
Okay, so with that big picture in mind, let's get into the quarter itself. It seemed like a pretty clean beat across the board.
Operationally, this was a fantastic quarter. Let's start with revenue. It clocked in at $229.2 million.
And that was up, what, about 15.5% year over year?
15.5%, yep. And it beat the consensus estimates by a solid $4.4 million. So really strong on the top line.
And the bottom line also looked good, though. There was a little bit of noise around the EPS figures, wasn't there?
There was, but it's a technicality more than anything. The GAAP diluted EPS was 0.29 cents. That beat the Zacks consensus of 0.27 cents.
So a clear beat on the number most people watch.
Right. Some of the higher consensus targets were for what's called primary earnings, which can exclude things like stock-based comp. But look, the main JAP number came in ahead. That's the win.
What really stood out to me, though, was the pipeline strength, the bookings number.
Absolutely. Total bookings hit $260.1 million, which was above their own guidance. And here's the critical part. That's 14.3% year-over-year growth, and that growth is accelerating from earlier in the year.
And when bookings accelerate, that gives you much better visibility into future revenue.
That's exactly it. It sets a very strong tone for what's to come.
Okay, let's move past the headlines then, because the real story seems to be in the financial architecture. You know, the operational leverage and the cash generation.
The margin expansion this quarter was just exceptional. Adjusted EBITDA hit $70.1 million. That's a 30.6% margin.
Wow. And the expansion year over year?
A massive 610 basis points. You just don't see that kind of expansion in a service-heavy business very often.
So how did they pull that off? It can't just be an accident.
No, it was very deliberate. Two main things. First, just general corporate efficiency. G&A expenses improved by about 150 basis points.
Okay, some good discipline there.
But the real structural change was labor. Direct labor costs improved 180 basis points. And this isn't about cutting staff. This is the first real proof point of their automation strategy.
You mean the eGates?
The eGates. They're already showing up on the income statement through better labor efficiency. It's a really compelling sign.
Which is a good transition because we have to talk about the cash flow.
Yeah.
If you just glanced at the numbers, it looked, well, kind of disastrous.
It did, and that's the most important clarification for you to take away today. Operating cash flow was negative $37.3 million. Free cash flow was negative $53.5 million. On the surface, terrible.
But this was all because of one single massive and very predictable event.
Precisely. The annual lump sum payment to their big credit card partner, it happens every Q3.
And that payment was huge this year.
Roughly $229 million. I mean, think about that. They took a nearly $250 million cash hit, and their free cash flow was only negative $53 million. That tells you just how powerful the underlying cash generation is.
And this is where management, I thought, showed some real swagger. Despite that huge cash outflow, they actually raised their full-year guidance for free cash flow.
They did. They bumped it up from at least $310 million to at least $320 million. It's a huge signal of confidence. They're basically telling the market, we know Q3 looks weird, but the cash machine is running so well, we're raising the target for the whole year.
Even after factoring in the cost of deploying all those new eGates.
Exactly. It's a really powerful statement.
So speaking of the core business, let's look at the membership numbers.
Okay, so the paid Clear Plus members, the ones we see at the airport, reached almost 7.7 million. That's up a solid 7.5% year over year.
But the total enrollment number was way, way bigger.
Right, this is key. Total cumulative enrollments ballooned to almost 36 million. That's up over 35% year over year.
That's a massive difference in growth rates. Can you explain that for everyone?
Definitely. So Clear Plus is the paid subscription. Clear One is their enterprise identity platform. So those 36 million people, many of them aren't paying that annual fee themselves. They're being enrolled through partners like a healthcare system.
So the 7.7 million is recurring revenue strength, and the 36 million is platform adoption.
You got it. One shows the money today, the other shows the potential for tomorrow.
Okay, now, the one area people were watching closely was retention. Gross dollar retention slipped a bit.
It did. It came in at 86.9%, which was down about 2 percentage points from last year. But management seemed totally unfazed by this.
And the reason is that 24-month cycle, right?
Exactly. You have to remember, they had those big price hikes back in 2023. We are now seeing the last big wave of members who signed up before that hike come up for renewal at the new higher price.
So this was an expected, calculated bit of friction from a past decision.
Precisely. Their view is once this group cycles through, retention will stabilize, especially since the price changes this past July were much smaller. They think the worst is behind them.
And the fact that they're still paying out a regular cash dividend suggests they're pretty confident in that long-term cash profile.
It certainly does. They're playing the long game.
All right, let's pivot to that strategy because that's where the future growth comes from. The call really broke it down into two distinct engines.
Engine 1 is all about automating the core airport product.
Yeah.
And the star of that show is the eGate rollout.
And it seems like they're deploying them even faster than they expected.
Much faster. They're live in 10 airports now, but they're targeting around 30 by the end of 2025 and a full network rollout in 2026. The pace is picking up.
What's the actual impact for a traveler?
Its speed and experience, the data they shared was pretty incredible. The eGates do the identity verification in about 5 seconds. The whole process to get you to physical screening takes maybe 30 seconds.
Members are calling it magical, I think was the word they used.
They did. And that's what drives retention. But as we said earlier, it's also about the margin story.
Right. If a machine does the 5-second check,
it frees up the human ambassadors to do higher value work. And that's where the Clear Concierge service comes from.
Tell me a bit more about Concierge.
So it's their super premium personalized service, and it's live in 23 airports now. Instead of just checking your ID, the ambassadors become these high-end guides. They'll help with bags, navigating the airport, you name it.
And it's working. People are using it.
They reported strong repeat usage. So it seems to be a successful upsell that's only possible because the eGates freed up that labor.
So that's engine 1. Automate the core, improve the margin, and create a new premium service. What's engine 2?
Engine 2 is the Clear One enterprise platform. This is what's driving that huge 36 million enrollment number and extending them way beyond travel.
And it seems like it just had its best quarter ever, if you exclude that one-time COVID health pass bump.
It did. And the traction is coming from some really key verticals. Healthcare was a huge win they highlighted.
The Epic MyChart integration sounded massive.
It is. I mean, Epic is used by millions of patients. Clear's platform now enables secure biometric digital check-in for all of them. Plus, they've signed contracts with over 20% of the companies involved in a big government pledge on patient data. They are embedding themselves deep into the healthcare system.
And it's not just healthcare.
Nope. They're pushing hard into what they call workforce identity lifecycle management.
So replacing corporate ID badges with biometrics for employees.
Exactly. Everything from verifying someone before you hire them to giving them secure access to sensitive data. It goes right back to that people are logging in threat. It makes clear a need to have, not a nice to have.
And all of this is happening while they're also just expanding the basic network.
Right. They're in 60 airports now, and crucially, they've opened up eligibility to passport holders from over 40 countries. That just massively widens their addressable market.
Okay, so let's tie all this great execution to the forward guidance. What did they say about Q4?
The guidance was strong. It really reinforced all that positive momentum. Revenue is guided to the $234 to $237 million range.
But the bookings number is the one to watch again, right?
Always. And they guided Q4 bookings to accelerate again sequentially to between $265 and $270 million at the midpoint. That's about 16.8% year-over-year growth.
So accelerating bookings on top of a raised full-year free cash flow guide, that's about as confident as a management team gets.
And, the macro environment is really a tailwind for them. TSA throughput is structurally high, and the need for enterprise security is only growing.
Let's talk about how the market reacted, because it was a bit of a roller coaster on the day of the release.
It was. The stock gapped up over 15% in the pre-market. The algorithms and early traders loved the headline beats.
But then it faded pretty hard during the day.
It did. A lot of traders sold into that initial strength. But here's the interesting part. By the close of the second day, the stock was still up about 13.5% from where it started.
So the quick money sold, but the longer-term investors stepped in and bought that dip. What does that tell you?
It tells you the stock is at a balancing point. Investors are now, I think, very confident in the cash flow story and the automation angle. The FCF raise sealed that.
Right.
But they are still trying to get comfortable with two things. First, has gross dollar retention really stabilized?
Yeah.
And second, can they justify the premium valuation, which is more like a software company than a travel service?
Which brings us to our next segment. A quick reminder for everyone listening, this is absolutely not financial advice. We're just taking the data from the call and spinning up a plausible, if aggressive, thesis.
And the thesis this quarter really writes itself thanks to that cash flow signal. My pitch is long, clear, secure, ticker YUU, and short a basket of generic travel tech.
So you're saying the market's initial fade was a mistake? You think they misread the cash flow?
I think it was a gift. That massive $229 million Q3 headwind completely masked the true FCF power of this business. And management just screamed it from the rooftops by raising guidance to over $320 million.
You're betting on a full re-rating of the stock.
I am. The stock is shifting its identity. You can't think of it as just a travel volume stock anymore. It's becoming a high-margin secure identity platform powered by automation with the eGates and diversified with Clear One.
So the trade is to bet that the market starts valuing it like a software company, not a travel company.
Precisely. We should be targeting a re-rating toward that higher multiple identity software peer group. The proof will come in 2026 as the eGate and concierge margin improvements really start to hit the bottom line. The near-term catalyst is hitting that 16.8% bookings growth in Q4.
And what's the kill switch on this trade when you get out?
It's simple. If they report Q4 earnings in early 2026 and they miss that bookings acceleration target, or if retention somehow gets worse, you sell. It means the thesis was flawed. Otherwise, you ride it for the margin story.
A very compelling idea, built right on the back of management's own confidence.
So to just sum it all up,
Yeah.
Clear really showed strong execution on a very smart dual strategy this quarter,
Automating the core airport business with eGates to drive up margins.
while at the same time expanding the whole platform into these high-value enterprise areas like healthcare and workforce identity with Clear One.
They're moving from just being a line skipping service to building out this whole home-to-gate, cross-industry identity network.
And the critical question for you to watch over the next few quarters is really this. Can that powerful automation-driven operating leverage outrun the last bit of pressure on the retention numbers and truly justify that premium valuation? That's the whole ballgame.
The high-stakes balancing act is on. Thanks for joining us for this deep dive. We'll see you next time.